In 1998, money poured into anything with a .com web address and a hyper-customer growth story. The Nasdaq jumped nearly 74% in 1 year, and by March of 2000, the exchange had peaked at over 5,000. By October of 2002, the Nasdaq collapsed to about 1,100, a decline of nearly 78%. And now the same people who predicted the market crashes in 2002 and 2008 are saying AI is about to collapse our current market and leave investors even worse off than during the dot-com crash. Trading on hype, narratives, and promises of never-ending growth, investors plowed billions into Pets.com, Webvan, and eToys.com. These companies leveraged the efficiency of digital marketing and communication to triple in size each quarter while losing money faster than they could make it. And for a while, investors didn't seem to care. Startup founders were weaving fantastic stories of the new digital economy and how the internet was going to make everyone rich beyond their wildest dreams. Then the bottom dropped out. Interest rates ticked up, earnings reports were unimpressive, and investors started to realize there was nothing behind that hype. Just a great story about a company with tragic financial prospects. Michael Burry, yes, that Michael Burry, as well as Paul Tudor Jones and others have been warning the reckoning is coming. Their predictions run the gamut from one large AI firm crashing and pulling its peers down with it, to the potential for the current rotation out of software turning into a rotation out of AI positions as they continue to drive untenable valuations and share prices. You may want to run to shout into the comments section about how many times Burry has been wrong, and he certainly has been wrong many times. In his most recent Substack post, he readily admits he's gotten some predictions wrong, but he's also proven he can profitably match patterns and see themes in the market. And now Burry is comparing our current market to the 1999-2000 dot-bomb bubble. And he may have a point. The parallels are undeniable, and the precedent set by that crash is too salient to ignore. First, let's talk about valuations and share prices. One of the ways investors try to assess a stock's relative value is looking at the share price compared to the earnings of a company, called a price-to-earnings ratio, or PE. At the height of the dot-com bubble, the S&P 500 had a forward PE ratio of 24 times, meaning that at the index level, it was collectively trading at 24 times projected earnings per share, a 24-time multiple. Guess what that ratio is in 2026? 23. And then there's the concentration of investment around a handful of companies. In 2000, the top 10 companies represented around 23% of the total S&P 500, and was concentrated around dot-com and tech companies. And if you thought, isn't the market even more concentrated now? You'd be right. The top 10 companies today have represented as much as 35% of the S&P 500 and are concentrated around AI and AI-adjacent companies. In 2000, it became common for narratives to override fundamentals. Founder CEOs would stand in front of investment bankers or sit on CNBC panels and talk about explosive growth, first mover advantages, and how their company was the leader in bringing cutting-edge technologies to market. They seldom shared their P&L performance or mentioned their negative unit economics. This was the birth of the hockey stick graph, showing user acquisition in a near vertical line up and to the right. And investors convinced themselves the old way of evaluating a company and their potential just didn't apply anymore. That massive returns from these high-growth companies was inevitable. Who cares if they're losing hundreds of millions each quarter and take on enough debt to sink an entire banking system? Just look at that exploding price per share. Fast forward to today, and the same mentality is pervasive. Elon Musk promises robo-taxis or autonomous semis, and you can watch your Tesla stock go up, despite them not passing major regulatory hurdles to put them on the road, or that they won't be fully autonomous for years. Or listen to Satya Nadella talk about the massive growth in Azure, despite 50% of all revenue coming from OpenAI, while Microsoft books the $500 million in Azure credits given to OpenAI as an equity investment as revenue, and track Microsoft's 25% increase in total market capitalization in 2025. And then the regulators and exchanges changed their rules to facilitate this fever dream of a market. Want to be listed in the Nasdaq 100 15 days after your IPO? No problem. Want to ignore the 10% public float requirement? Fine by the folks over at the Nasdaq. Are we this dumb? Can we not understand why this is nuts? How do we ignore the similarities and the near-perfect symmetry between the failure of the markets to recognize basic financial realities in 2000 just to replicate them without any sense of irony in 2026? According to Burry, it's because we've gotten greedy. You know, one of the best ways to support small YouTube channels like mine is to subscribe. If you like the content and you'd like to see more of it, consider subscribing. Back to the episode. I personally prefer Burry's term supply-side gluttony, where the supply of capital is so strong that it continues to buy into companies at ever-increasing PE ratios. If the stock went from 220 a share in 2023 to 350 in 2025, surely it will go to 460 by 2027. They will tell themselves it's much better to overpay now than miss out on any future upside. In fact, algorithmic trading strategies actually overweight stocks with increasing prices and high trading volume. Those two metrics, untethered to the underlying financial performance of a company, triggers more buying and boosts support for these unhinged share prices. And according to the SEC, the majority of all on-exchange trading volume is driven by electronic or algorithmic trading. This is why you'll see a negative inflation report come out, but the markets go up. One of the Mag 7 reports earnings that exceed expectations and the share price goes down because some block of investors didn't like the revenue mix or the growth rate seems too flat, all while holding a stock with a PE ratio north of 100. We've gotten to the point where the stock market seems to have almost no correlation with actual capitalism. So what happens now? Depends on who you ask or choose to believe. Predictions vary from a prolonged and gradual correction to flood and famine, the very existence of Western capitalism snuffed out by one broken OpenAI IPO. There are some that don't see any issue with these market dynamics, that our current market valuations bear no resemblance to the dot-com bubble, and if you say otherwise, you're just pushing a contrarian agenda for attention. Goldman Sachs, Bank of America, and others believe these companies have revenue streams and cash flows that are much more robust and diversified, even if they are concentrated into a few companies. They cite NVIDIA and Microsoft as two companies that have significant revenue sources and cash that aren't dependent on AI. That last point, especially relative to NVIDIA, I find laughable. NVIDIA's market cap didn't launch into orbit because of its GPU gaming revenues. But those shops are talking their own book, which is to be expected. Let's pretend time is a flat circle and we replicate the dot-com bust where the US stock market lost approximately 37% of its value. In the trough of 2002, that meant $6.5 trillion of market value evaporated. Adjusted for inflation, that would be roughly $12 trillion in today's dollars. If our current market lost 37% of its value, the total market value would crater by nearly $50 trillion. That means we would have lost 4 times as much market value in today's dollars. I think catastrophic is not too strong a word choice here. Let's not forget the US went into a recession in 2001, immediately following the dot-com bubble bursting. I'm not in a position to offer any investment advice. I'm not that qualified and you probably shouldn't listen to me anyway. All I can offer is some reassurance that if you're feeling like this doesn't make any sense and wondering how Elon Musk can, with a straight face, roadshow a $1.75 trillion SpaceX IPO in 2026 when the company generated a net loss of $5 billion in 2025, you're not alone. This market doesn't make sense. It is fundamentally devoid of logic, and when the capital supply gets thinner or interest rates are forced to go up again, or investors realize for themselves this is batshit crazy, we will have come full circle, right back to 2002, having learned nothing. Only this time, the US stock market is 6 times larger than it was in 2002, and if history does repeat itself, a recession will seem like the most merciful outcome possible. That's it for this episode. As always, like, comment, and subscribe, and we'll see you next time.